Thanks everyone for joining us Monday afternoon, morning, wherever you are located. So today we're going to talk about optimizing control strategies to minimize cyber risk and reduce fraud. So we're going to kind of cover, Kyle and I are going to cover both the external threat with the cybersecurity and the internal fraud with the more like embezzlement type cases. So to get started here, there we go. A little bit about Eide Bailly. We are a top 25 CPA firm in the nation, been around for 100 years, but we're much more than that. As Kyle and I are going to talk about today, you know, we do have the tax and audit services, but a lot of consulting services. And that seems to be the growing trend in today with our clients, with clients out there in general, with businesses. They need more help and there's more risk to them. So Kyle and I are going to talk about that from a forensic accounting side, as well as a cybersecurity. So a little bit about our map. We're, you know, in 40 plus offices in 15 states and India. But Kyle and I do have clients throughout the nation and international clients. So we are available to help. But today we're going to give you some tools and some best practices. Myself, Eric Hansen, I'm a senior manager in our forensic accounting practice. I'm based out of Sioux Falls, South Dakota. And then Kyle is going to speak shortly here, and he is our director of cybersecurity, and he's out of our Fargo office. So with that, we're going to talk, like I said, cyber risk and fraud threats, internal and external. We're going to go over internal controls and best practices, how best to prevent these issues if we can, if not detect them right away. And then we're also going to go through some real life case examples and what are we seeing as actual practitioners and doing these examinations. What are Kyle and I seeing? So we're going to go through those lessons learned to hopefully prevent this in the future and help you guys. So with that, I will turn it over to Kyle.
Well, I'm going to start off here, Eric, and I appreciate the introduction here with just a message that we don't get to choose if we're a target against a cyber incident, against ransomware, against any sort of an attack. The victim never chooses to be a victim. So let's keep this in mind as we go through this presentation today. It's not just the people that are on this webinar that have cybersecurity as a concern for them. In a recent survey here, 35% of CFOs say cybersecurity is one of their highest concerns. If you walk into nearly any leadership group or corporate board meeting, cybersecurity is going to be on the agenda and how the organization is going to reduce or manage that risk. So when we start talking about cybersecurity, how does this bad stuff come in and impact us? So looking at IVM Securities X-Force survey that was running data from 2020 versus 2021 full year data, we know that malicious actors are primarily coming in through phishing or exploiting vulnerabilities in our environment. So when we start talking about things and strategies for mitigating this risk, we all have people within our businesses that we are paying to open and click on things in email. So while security awareness training is an extremely large part of what we're talking about here to prevent phishing, we also know that legitimate organizations are going to be compromised. For example, one of your vendors gets compromised. How do you know that the person on the other end of the email is who you expect to be there? Does an adversary have control over that email account? And if so, when we start talking about business email compromise and vendor payment fraud, those types of things, what type of controls do you put in place to minimize your chances of being taken advantage of if someone changes payment request details or address changes or contact information changes for someone that you normally do business with? How do you know that you're sending money to the right places? And then when we start looking at vulnerability exploitation, we do vulnerability assessments for organizations right now. And when we do those, we've changed our focus over the last few months from what we used to do to how do we properly manage risk in an organization around vulnerabilities. Is your vulnerability program answering questions around, is your patch management processes working effectively? Um, Are you properly managing the risk of end-of-life operating systems? Are you managing vulnerabilities that have known code that can be exploited associated with them? And are there things, as we get into the attack chain later here, are there things that are so dangerous that you should basically just drop everything to minimize those steps through the attack chain from an adversary perspective? And we'll get into that attack chain in just a little bit here. And then stolen credentials, brute force, remote desktop, and password spraying. These next items really emphasize the need for multi-factor authentication. And so when we're doing things like multi-factor authentication, are we doing a different approach across all of the different solutions that we have out there, 15 different ways for all of our employees and our coworkers to access things online in a safe manner? Or are we implementing one approach that allows you to connect everything else so you can be confident that you're covering everything consistently and how your employees are accessing things remotely? Vulnerabilities, again, are a compounding problem. Last year, close to 20,000 vulnerabilities were discovered. The year before, a little over 19,000. The year before, a little under 18,000. This is going to keep getting worse and worse. And again, going back to that idea that not all vulnerabilities should be treated the same. There's criticals, there's highs, there's mediums, and there's lows. But also, we know that certain vulnerabilities have known exploit code, things that are already written to take advantage of these vulnerabilities. We know that these items are the ones that contain the most risk for organization because they're ready to be weaponized, they're ready to be taken advantage of, and it's already known on how to do that. These are items that we need to focus in on first. Otherwise, our vulnerability management and how we do patches across our organization is just going to run out of control, and we're not going to make any meaningful progress. We also know that although the average for a non-ransomware level breach is typically around 180 something days before an organization finds out that an actor was in their system, we know that ransomware is driving this trend down much, much sooner. So the average for a ransomware intrusion of being a ransomware actor being in an environment, well, it can be as short as hours or as long as about 9 days. So these are shortening that attack cycle that we're all having to deal with in our environments. So my question to all of you is, who's watching? Who's paying attention to this kind of stuff? Who's watching what should be watched? We also know that it isn't magic. An adversary doesn't just jump to disaster. They have to go through certain steps first. They have to get malicious code on an endpoint. They have to get it to execute. They have to get the ability to survive your computer restarting. They have to get more rights than what they have originally. They have to be able to control that computer from somewhere out on the internet because they're not right next to you. They have to be able to discover more systems and compromise those and move throughout your network until they get enough systems compromised or they get to the right data to steal to take action on that. They have to observe the same laws of physics as we as defenders do. And knowing that you can't just jump to the end, you can't just jump to disaster, gives us as defenders a huge opportunity to catch a malicious adversary in the act. We want to catch, as we start talking about this whole attack chain, this 1 through 12 step process here, we want to catch them earlier in that attack chain than we do at the end. The end is disaster. The beginning is just an incident. We want to catch them as an incident before there's a breach, before there's a ransomware demand, before there's extortion on releasing data, before there's manipulating of our accounting systems or our payroll systems. We want to catch it earlier in that life cycle. We also know that in most environments, it doesn't take a lot of steps to get to disaster. Now, the number of hops within systems per breach in what was observed across 2021 by Verizon in their data breach investigations report, typically five actions or fewer, and knowing that certain steps can be combined, but that speaks to being able to have visibility across all of your systems. And that's not enough. We still need someone who knows what to look for. Are you testing your environment against those steps of the attack chain to know where you're good and where you're not so good at? Certain steps of the attack chain are just really hard for all organizations. That detecting that remote control, that C2 traffic, is really hard for nearly everybody. Detecting an attack when it's in the data exfiltration phase, when they're stealing data from you, that's also extremely hard to detect. DLP systems have not evolved to the point where they make this stuff easy. Knowing that those two specific items are going to be hard for nearly everyone, what type of testing are you doing and what type of controls do you have in place to identify an adversary earlier in other phases of the attack? And how do you trust but verify? We recommend and we use offensive testing. We use things like an assumed compromise type testing engagement, typically called a penetration testing event, where we're working through this attack chain with a client. We're starting from the point of using a actual user's computer as the starting point for the test. So someone who's recently departed, a new system that's been set up for a new person, using that as our device, assuming that a malicious actor is going to get on one of your systems eventually. Starting from that, we test throughout your IT control structure, along with testing throughout the attack chain. So we want to understand, are your defenses or your detections working properly for malicious code execution? Can they find privilege escalation? Can they find someone moving to other systems, moving laterally within the environment? Can we understand the risk that your organization currently operates under by either failing to test this way or assuming that your controls were working when they weren't? And it's amazing how many times we uncover that even with planning, without testing, a organization is still under significant risk. We also know that ransomware wasn't really a thing in 2017. This date is going to be really important in a couple of slides here. We also know that ransomware is exponentially rising at this point, and this is as of full year data in 2021. Ransomware is something that we need to make plans for. We need to have an incident response plan. We need to be able to test throughout that attack lifecycle, that attack chain type testing, assumed compromise testing, and get assurance that you have the right things in place to properly protect your organization. We need to make sure that you have the right things in place to properly recover if an incident should occur. And do you have a plan for how you're going to respond as an organization if something should occur? We also know, based on statistics since 2020, that the average ransomware demand is approximately $247,000. What does a $250,000 payment mean to your organization if you were not planning for it? Does that mean you have to lay off people? Does that mean you have to close the business? Does that mean you have to shut down for a period of time? We know that the average downtime since 2020 associated with ransomware is 22 days. That figure's actually gone down in last quarter of last year to 21 days. What does 3 weeks of having no IT look like to your organization? Can you survive? Where I previously worked, I was part of the leadership team there, and we decided as an organization that after 3 days of downtime for our organization, our business would be forever changed. We knew that we would probably survive, but we knew that the customers that we were able to retain through this downtime would be different. We knew that our revenue would be different. We knew that the number of employees that we had would be different. Things would be different. Really, really hard decisions would be forced to be made. And we were well prepared. What does it mean to your organization? We also know that when an organization goes through an attack, this impacts leadership. This approximately 32% of companies that have been through a ransomware event end up losing one of their top leaders. And this isn't just IT, this is CEOs, this is CFOs, COOs. These are the people that we're depending on to lead us through the difficult times. And in 32% of the times after going through a ransomware event, they either are asked to leave or they decide they're going to leave and resign under their own accord. How are we going to fill that gap from a leadership perspective? I mentioned earlier about vendor and business email compromise. A quick story about an airport doing a building project down in Florida. One of their construction vendors that was participating in the build out of the improvements to the airport got their email system compromised. The malicious actor then had full access to the email trail and the correspondence between that vendor and the general contractor. They requested payment details changed. They requested a bank change on where funds should be sent. And then they requested payment on an invoice out of cycle. Out of the airport construction funds, this was paid $740,000. Now, they didn't find out about this until 3 months later. Those funds are gone. This is non-recoverable. So suddenly you sent money somewhere and it's gone, but you still owe money on the original bill. How is your business set up to handle that? Does your cybersecurity insurance policy cover that? Do you have cybersecurity insurance? So knowing that 2017, ransomware wasn't really a thing. That's that date I called out earlier. At that time, a lot of organizations were using cybersecurity insurance as their cybersecurity program for their organization. They thought they'd just get compromised. They first of all, they didn't think they were going to get compromised. And if they did get compromised, they would just use cybersecurity insurance, recover, be made whole through the insurance carrier, and be up and running again. Then in 2017, ransomware came on the scene and insurance carriers started taking losses. They started have to pay out claims. Insurance carriers don't make money by paying out claims. They make money by just collecting premiums. They also have extremely intelligent people, actuaries, statisticians, to understand what are the key things that should have been in place that would have prevented them from having to pay out all these claims. So starting in around 2020, insurance carriers, insurance brokers started going through These are the things you have to have in place in order to get your renewal. And they got a lot more serious about it over the last 12 to 18 months. So the 5 orange things, the first 5 things: multi-factor authentication, EDR, tested encrypted backups, privileged access management, email filtering, and web security. These things are all required now before you can get your renewal for most carriers. Not having these in place means you're not going to get cybersecurity insurance coverage. We also have the blue things, the other 7. So these 12 controls. The carriers know that these are the things that reduce risk of them having to pay out claims. This is also a cheat sheet for every small business that doesn't know where to start on how do you minimize or reduce cybersecurity risk. Not just checking the box on all these 12, but doing them all well. So when we look at where do we start, we want to understand what the gaps are for an organization. We want to do testing to identify control gaps, IT security control gaps. We want to do assessments against known good frameworks like NIST and their cybersecurity framework, or the Center for Internet Security and their 18 critical controls. So we want to understand, where are you at now, and where are the gaps to where you need to be to properly manage risk. We want to create that roadmap for you on how do you get better? How do you get to where you need to be to properly manage risk? We want to integrate. We want to make sure that from that point forward, we're building things in a secure manner up front. And then if there's things that need to be fixed, those vulnerabilities or configuration weaknesses that are identified, we want to make sure we're fixing them and solving them in a way going forward that they don't come back up. And then we want to maintain, we want to monitor. And so this is where managed security services come in. Having somebody that has eyes and is ready, or eyes on security logs and events going on in your environment, and is ready to respond appropriately if bad things are happening. And knowing what to look for. Again, we want to focus in on those things that would directly impact the attack chain. So is somebody running malicious code on an endpoint? Are they trying to escalate or elevate privileges? Are they trying to compromise other systems? That whole circle of the attack chain, and making sure that somebody's properly monitoring and looking for the right things. Compromise is inevitable, but it won't ever happen to me because it's never happened to me before. I don't have to worry about it. This is something that I got to hear from a client recently in the last 3 weeks here. And with Thanksgiving season coming up here, I thought of this a different way. There's nothing in the life of the turkey that it has ever experienced that would prepare it for what happens around Thanksgiving. Is that us? Are we the turkey? Eric, I got to turn it over to you with the turkey talk.
All right, I don't know if I have any great analogies of turkey, so I can't beat that. But thanks, Kyle. I appreciate it. So I'm going to talk about internal fraud. So I'm going to switch it up. Kyle covered the external fraud and the risk and cybersecurity and the technology component. So now we're going to do complete opposite 180 and go internal fraud, and we're going to talk accounting. So I apologize if there's any tech people on here. We're going to now get kind of nerdy and talk accounting. So we'll go on from there. We're going to go through fraud schemes. First, we need to understand what type of schemes are out there. How is this fraud committed? So how can we protect ourselves? And to start, I'll have Amy put up a polling question, kind of judge everyone's experience to see who you think is most likely to steal from your organization. Couple options: either the new employee, someone that's been there forever, trusted employee, or no one can steal from your organization. Curious to kind of see the results here. All right, 82% long-time trusted employee, which is the correct answer. Throughout my years of experience, throughout thousands of surveys, tens if not hundreds of thousands of surveys, it is a long-time trusted employee. I guess no one maybe could be a correct answer too. If you're a one-shop employee or something like that, you're the only one. So that might as well be the answer. But long-time trusted employee, and the reason for that is we're going to talk about an internal control breakdown, right? They've been there a long time, could even be a family member. They're trusted. What they do is they have more job duties, more job responsibilities, and the internal control, your separation of duties starts to kind of weaken, and they get asked to do more. Well, now you have this opportunity for fraud. So fraud is committed through the fraud triangle. You have some sort of pressure, whether it's bills to pay or some sort of gambling addiction. You have pressure. And the next step is your opportunity. There has to be an internal control weakness for the fraud to occur. There has to be that opportunity. Then they have to rationalize it. And they rationalize it by, I'm overworked and underpaid. The company has millions of dollars. I can take 10,000, something like that. And so that longtime trusted employee, has that opportunity. All they need then is that some sort of pressure, and then they usually can justify and they usually rationalize it. So we'll go on to the next one. The ACFE, this is the Association of Certified Fraud Examiners, the gold standard in fraud. Every 2 years, they put out a report to the nation where they survey thousands of fraud examiners to, what cases are going on, what are they seeing, what are the results? And they're usually very similar. There's different trends, but here's the fraud tree. Financial statement fraud, we're not really going to get into that. That is your Enron type cooking the books. It's your publicly traded companies, and it's rare, but when it does happen, like Enron, it's a disaster. Asset misappropriation, this is the main, the most common one. Obviously, cash and inventory are the two items there. And this is the lowest amount of fraud, but it does affect the most amount of small, medium-sized businesses, even large businesses. And then in between that's your corruption schemes. Very similar to asset misappropriation, but involves more than one person. So this is where we run into conflict of interest, bribery, kickbacks, illegal gratuities, those sort of schemes. And we're seeing an increase in that, especially with conflicts of interest. That's something to be aware of. When I started doing this 10, 15 years ago, we weren't really running into those sort of issues. Nowadays, it seems like everyone kind of has a side business or knows someone that has a side business. You're going to want to make sure you have a conflict of interest policy in your handbook. So if whoever's doing the purchasing and the bidding, who can they do business with? Or if there is a side business, do they have to declare it? A conflict of interest policy, we don't see a lot in these handbooks and employee manuals. That is something to make sure to see if you can get that in there. And not that it's wrong to do business with a known vendor, just we have to disclose it so everyone's aware. A little bit more about the fraud schemes. So as you go further to the right, to the more risk, billing is up there. And the higher you go, that's the loss. So the billing schemes are your most common, and they're also your largest loss. $100,000 is the median loss in 20% of the cases. So obviously, this fictitious bills, paying personal expenses is run through a billing scheme. Same as check and payment tampering, taking the money. All the way down to the bottom left is your registered disbursements. It doesn't happen that often, and it's a smaller dollar amount comparison. Usually you're not taking money out of the till and the register. They're doing it through fraudulent disbursements, which we're going to talk about. So I like this little stat diagram. The top 5 concealment methods used by fraudsters. So they have to commit the fraud, and then it has to go, it's hidden. So fraud, one of its natures is it's concealed. That's one of the elements of fraud, is its intent, and then they conceal it. And these are the top 5. The first 2, creating or altering physical documents. The next 2 is either creating or altering electronic documents. And then the last one, they just destroy or do not produce physical documents. In our experience, we've seen all 5 of these. It is common, and we're going to talk about this from an internal control perspective. What does this mean? That they're creating or altering documents. So creating a fraudulent document, that would be a fictitious invoice. I bought something personal. I just created a whole fake invoice, put it in the file for the auditors. So when they look at it, okay, they see $10,000 coming out of the bank account. Well, now it looks like I bought this piece of equipment for it, something like that. altering physical documents. What does that look like? A bank statement where you have a Capital One credit card that comes out automatically on your bank statement, and there's a way to alter it, and you overwrite that, and it looks like you paid a vendor for that. You just put the name of the vendor over that. So it's still the same document, you just altered it a little bit to conceal who got paid. And like I said, we've seen all these. The internal control, what you should do here, the best practice to take away from this is all these documents are altered and created by the fraudsters because they have access to them, and then they produce them to someone. They produce them to the CFO, to the CEO, to the board members. The best practice you should do is those individuals that need to review these documents should get them independently. They should log into the online banking and print them themselves. They should get them mailed to the board member. 2 board members should get them mailed to their offices, their house. They need to independently get those so they know there's no chance of them being altered or created fictitiously. So like I said, a billing scheme, I want to go through some examples. This is a case we worked a while ago. What the red flag was is this business had found an altered invoice. They were looking at their newly created flexible spending account, a medical account, and they're looking at some of the payments they were paying out to employees, and they found one that just kind of looked off. So they confronted the individual managing that and said, what's this invoice? Why are we paying out, from our flex account? And it just didn't seem right. Individual confessed that, yes, I created that. That shouldn't have been paid out, but so I created it. So then we got called in. They're like, all right, we found this one thing. What else is going on here? We did a 5-year look back, and what we found during this time period is this individual took an insurance check that was supposed to be paid to the business, and they got endorsed on it. So then they deposited themselves in their own account. They had unauthorized disbursements where they were just paying their own bills with the bank account. And then they had personal credit card purchases as well that they were running through, about $35,000 over 5 years. And how we found some of this is through computer forensics. We looked at some of the invoices and things looked legit, and we just kind of had some red flags, some feelings. So we asked to do some computer forensics. We took the computer of the individual there at the office, and then one of the first things we found on it was an invoice template. If you're looking at computers and you see any invoice template, any Excel document that looks like that, huge red flag, because usually you have QuickBooks or some sort of system for invoices, not an Excel template. What this individual did is created fictitious bank accounts. And so they grabbed the logo from their bank and things like that and did a pretty good job at it. But when we requested the actual bank statements from the bank, compared the two, we could easily identify what they were changing. So, that one ended up, I think, going criminally. I think that individual was charged out. But the internal control weakness is there. This individual is doing everything with accounts payable, preparing the checks, entering the accounting. They weren't signing them. And some people I hear say, well, I have 2 signers on my checks. To me, whether you have 2 signers or 1 signer, it's not really a control. Anyone can forge a signature. I've seen checks clear the banks with no signature on them. The banks are processing, thousands and hundreds of thousands of checks a day. They're not looking at signatures. So, having just that control different of someone reviewing them before they're mailed out or looking at every check before they're mailed out would help to prevent it. However, not every business can prevent it. They might have 1, 2 people in the accounting department. So if we can't do a preventative control, we need to do a detective control. And so what I always recommend someone else involved either with the bank reconciliation, at the bare minimum, the best detective control is to have that independent person looking at the bank statements. They get them from the bank themselves. They log in online banking and they look at every transaction. It can be just high level. They maybe need to request supporting documentations for some of them and see what's going on. Another key takeaway, I have businesses and clients say, I do that. I go, do you look at the actual canceled checks? They say, no, I just see a check that cleared for $5,000 and the accounting says it was paid to this vendor. Well, you need to look at the actual canceled checks and where the money's going. And we're going to obviously talk about that later in a case on what happened there. But that was one of the billing schemes. So red flags. So kind of talked a little bit briefly with some of the examples, but what else is out there? 85% of all fraudsters displayed at least one of these behavioral red flags. You know, I usually put up the slide fraudster, and you pick the fraudster to what fraud they committed, and there's no rhyme or reason. There's no look of a fraudster. You can't just look at someone and say they're going to commit payroll fraud, they're going to commit this fraud, construction fraud, HR fraud. But what there is behavioral red flags, how they act, and their, you know, what they're doing in their job duties. The most common, living beyond their means. As you can see, that has been around since they've been doing this study for quite some time. Then obviously followed by financial difficulties, unusual close relationship with vendors, control issues, unwilling to share their duties. If an employee says, no, don't help me with my job, I'll get that later, and is constantly not letting someone involved in their work, there could be a reason. We see that is that they know they're committing fraud. They need to conceal that. They need to cover that up. One of the cases, if you guys have heard of the Dixon, Illinois, the largest municipality fraud in the United States, I believe it was like 55 million. You know, she created a separate bank account and funneled money into a separate bank account, and then, you know, was paying personal expenses out of that. There's a Netflix show about it, The Queen's Horses or something like that. But what happened, she went on vacation. Someone else started doing her job duty for that week, and they found that bank account. It finally became unraveled because someone else did her job duties. She can no longer control that. But so with these behavioral red flags, what a HR kind of disclosure and all that, I don't want everyone going accusing their employees living beyond their means. These are just red flags. I've had fraud cases where the client's like, I should have saw that coming, right? I don't know how that person afforded country club tickets or how they have 3 houses. You know, I should have saw that, you know, but they don't. Businesses are used to making profit, to generating more sales or to doing something else. Their main concern is not fraud. And so, you know, what you kind of got to do is just, okay, if there is a red flag here, how does this person have 3 houses when it's a bookkeeper making $50,000? And what we need to do is say, okay, well, what job duties do they have here? You know, is there any risk? Is there any internal control weaknesses? You know, it could be that they have inherited money. Their husband, wife could be well-to-do spouse, something like that. These aren't telltale that fraud is being committed. It's just something to be aware of if these people are doing your job duties. And don't overlook the obvious. Like I said, I know people that have 7-figure, you know, $1 million frauds, and bookkeeper making $50,000 has 3 houses and could not afford it if it wasn't for their fraud. And they just let it go, and they never really questioned these lifestyles. So number one kind of red flag to be aware of. Case 2, because I like to just sit and talk about cases. I find them more interesting than going through slides. So the next one here, I want to talk about the red flag since we're talking about that. Husband, wife business, a couple employees, family business, a lot of sales, a sales type business. And what happened was the husband received a call from a bank, a question about a check. The wife was trying to deposit a vendor check. The business had paid a vendor, and the wife was trying to deposit it into a separate account. And she, you know, the bank's like, this is suspicious. Why, you know, this isn't her. Why is she depositing this? You know, the wife had stated, hey, you know, I'm just trying to save up some money, so I created a separate account so we can have a little retirement account. So she told the husband. The husband started digging into it, noticed a whole bunch of payments in the bank account to herself, asked the wife about it. She said, hey, that's, you know, to pay the taxes. We have this large tax bill coming up. So I just started putting some money away so we can save for that. Husband then started saying, well, we should have, you know, $1 to $2 million in the bank account. We're pretty much broke. Like, where's the money going? And that's kind of when everything hit the fan. We came in and we looked back about a year and a half. In that year and a half, we found $260,000 of payments that had different payees. So what I mean by that is the check register and the QuickBooks showed all these payees were getting paid to vendors, cost of goods sold. When you look at the actual canceled check, it was really payments to herself. And so that's where I say it's important to look at the actual physical, well, not physical, you can look at it online, the canceled check image to see where the money's going. You can't rely on the check register or the accounting. Anyone can input that, as this fraudster did. We also found another $360,000 in other personal benefits through credit cards and just other direct vendors that she benefited, as well as that $50,000 fictitious vendor check. So roughly we're in the $600,000 to $700,000 in fraud in this year and a half. To make matters worse, This business then got audited by the state and feds. So now you have all these business expenses, cost of goods, and all these deductions that they're taking on their tax returns that were not actual expenses that they need to go amend and work with. So it just kind of, compiled there. Weakness, obviously, internal control weakness. The wife did everything. The husband was all responsible for sales. His job was just to sell, bring in revenue, right? The wife was on the other side of the accounting doing everything. So she had full access to it. Her living beyond her means was her lifestyle. She'd bought, a Rolls Royce, just kept spending, lavish lifestyle, trips like that, and no one just questioned it. And obviously she used the business funds for that. What the recommendations we small shop, they can't separate all their duties. But I told the husband, then you gotta every month look, if you're not doing the bank account, you need to look at where your money's going. Is your deposits what they're supposed to be based on your sales? And then the money going out, look at every disbursement and see where that money's going. So they implemented that. To finish up here, we're going to talk about internal controls and best practices. We've touched on that, but there's a few more details we can give you. Obviously, in this report to the nation, you can see the number one issue, how fraud was committed, lack of internal controls. The examples I told you, they didn't have any internal controls, person did it all, or override existing controls. We'll see that. We'll talk to businesses and say, here's how we do it. Here's our accounting policies and procedures. And I say, is that really how you do it? Or is that just how the paper and the manual says? Tell me how it's really done. Sometimes we may skip a step for efficiencies, or someone's out of the office, or I have a check stamp signature laying around to, so someone doesn't have to hand sign everything. But lack of internal controls and override of existing controls, 50% of the way. Then obviously it goes down from there on these controls. This one is interesting. Same study. After a victim organization had fraud, did they modify their controls or not? 81% of the time they did, but still, organization had fraud. 19% of the time they didn't even change what they were doing for their controls. And the story here is, it's reading an article. This organization had a financial statement audit, which financial statement audits are not designed to detect fraud. They're designed to tell you the financial stability of an organization. Is an organization, profitable? Will it stay in business next year? How's the financials looking? Someone stole $100,000 from Walmart, that wouldn't show up on their financial statement audit because it's not material to them. They're still going to be successful and still going to be in business next year. But what happened is these audits tell you internal control weaknesses. And they said, hey, you have an internal control weakness around X, Y, and Z. Let's just say your credit cards, there's a weakness here. This individual, the auditor told this organization that, and 5 years later, they were called back because that's exactly how the bookkeeper or CFO was stealing then. They told them how to steal. They said, here's your internal control weakness. And then something happened in that time period. There's some sort of financial pressure, that first part of the fraud triangle. Well, they told them where to do the opportunity. They said, here's your weakness. And then they somehow rationalized it. So the takeaways here is if you have that weakness, more than one person needs to know about it. The board, CEO, CFO, multiple people. And then someone needs to be accountable to enforcing that and fixing that and taking corrective action. It's one thing to just identify it, but if we don't change the controls and implement controls, then the weakness is still there. Now it's just known to everyone. So types of controls, 5 different high-level types before we get into the specifics. Entity level, this is the tone at the top. What I see here is if someone steals from your organization, do you just fire them and say, pay me back? Do you prosecute them? What's that tell to other employees? I've seen plenty of cases, people just want their money back and fire them. That just tells employees that, okay, steal from us and you're just going to pay back what you stole. Nothing's going to happen to you. You might lose your job. We need to hold them accountable. We always recommend if you want, criminal charges. Preventative, this is the best. Let's try to prevent fraud if we can. Most small businesses can't do this. They don't have enough resources or it's not efficient. So let's put that detective control in place. We want to catch fraud the very first time it happened, the first month. I always say, look at those bank statements, follow the money, right? Let's see where your money's going out or if it's not coming in like it should be. Automated controls, is there some sort of IT system we have set up where it can stop things? And then manual controls, this is like proven P card purchases or expense reimbursements where they enter it in and someone has to manually review it. Designing effective internal controls. Here's some more takeaways with looking at assets and constantly doing it. The bottom one, like there, consider the cost benefit relationship of these. When we come in and help businesses, we don't count pencils and staplers and all that. I'd be like, we don't want to spend 1,000 to save 100. You know, what's your biggest risk, and then work it down from that. Your biggest risk and your the largest dollar amount, and design it from there. So a couple specifics. So your general controls. And I'm not going to go through all of these because you guys can read them yourself, and the slide is available. So you guys will have all of these, as Amy stated, but some general controls, a hotline. Do you guys have, does the organization have an anonymous hotline where someone can call it in? TIP is the #1 way that fraud is detected. Employees on the ground, they know what's going on. They know that living beyond the mean, they saw something suspicious. You need to have a hotline system in play. Bailey, we offer that. Our clients will have it. It's really reasonable, like a couple $100. But just so your employees can report something if they see it. Most of the time they don't report it because they fear of it's their supervisor. They fear for their job. They fear that if they're wrong, something's going to happen. So that anonymous system to have in place. Accounts payable, credit card and expense reimbursements. We talked a lot about these with the schemes. These are money going out. When you get credit cards, make sure itemized receipts have to be submitted. And then the person that is reviewing these credit cards, they don't have one themselves. Multiple people involved. Too many times we say, yeah, we review credit cards, we get the statement, or okay, do you just pay the statement? Is it auto paid? Is actually anyone looking at receipts? Same thing with expense reimbursements, need receipts. One thing not on here is your business, you should be one or the other. You should have a business credit card. Employees should be able to have a business credit card and take that with them, or do expense reimbursements. We usually don't recommend both because there's a way to double dip, right? They can put it on their credit card and pay for a meal. Well, then also a month later submit as an expense reimbursement. I need reimbursed for that meal. And most businesses don't double check that they paid it one way or the other. So see if you can do that with that. Inventory, if your business has inventory, is it locked up? Is there security cameras? Who counts them, performs them? A case we had, to speak to the volume, it was a hospital, and in the hospital you think, with inventory, drugs or narcotics or things like that. This hospital actually lost $1 million over 7 years of diabetes test strips and printer ink cartridges. What the individual was doing was managing the inventory. They were taking all these two types of products, they were selling them online, for like half price, and everyone was buying them online. And then they would just keep ordering more. They would do adjustments every year to the inventory. And as fraud goes, it keeps getting greedy. Finally, someone saw how big the adjustments they were taking. And that person got 10 years in the California prison system. But you wouldn't think a hospital, right? Diabetes test strip and printer ink cartridges. So may not seem like the inventory is something big, but it adds up over time. Accounts receivable, money coming in, especially if you're a cash intensive business. Are you doing projected financials to actual? Is the money coming in supposed to be what you're receiving? And payroll, here we've seen plenty of, theft of time is fraud. Are they putting down 40 hours and only showing up 20? Do we have fictitious employees? Is there a way to give ourselves an extra bonus to change our compensation? There's multiple different payroll fraud schemes that can happen. So you need to see if you have outsourced payroll, where they can't do that as easy or not. But here's kind of some things to think of. So ongoing monitor, perception of detection is the #1 deterrent. I use the example, ADT house, you drive around a neighborhood and you see all these security alarm systems. You see, those stakes, we have ADT, this house is secured by whoever it is. Not all those houses have security systems. You buy those online for $5. I know when I had a security system, I gave a whole bunch to my friends and family. And so it's just that perception. No one's going to rob that house, break into that house, when right before they break the window, they see an ADT sticker on that. They know the alarm's going to go off. They're going to get caught. They go to the next person. Same thing with your business. That perception of detection. If you are, doing some ongoing monitoring, now don't constantly overlook your bookkeeper or CFO, whoever it is. Don't hover over them, but every month or every now and then ask for invoices, ask for supporting documentation, question them. They know that you're looking, that they're going to get caught. They are less likely than to steal from you. We'll move to the next slide. So in conclusion, you know, kind of some takeaways. If you take away anything, kind of this is the one slide, you know, from Kyle's side, from IT, you know, to have those plans, those strategies. You know, it's always a risk there, as well as on the internal side, you know, that perception detection and internal controls try to establish. So kind of, you know, take away this slide. But with that, is there any questions for Kyle or I? Yes, I do see one here about the fraud hotline and cost. I can respond back. I will need to look into that, and I can certainly reach out to this individual with that. So yeah, so the check approval process, would it be acceptable to scan all checks printed and signed before mailed out? Certainly. So then, you know, you can see, you know, depending who's signing them and who's mailing them, one of the things we recommend is whoever signs them, they just mail them. So let's go through that process. You have someone prepare the checks, enter them into accounting, checks 1 through 10. It goes to then whoever's signing them. Here's the 10 checks you need to sign. That person signs them. If that person can mail them out, that is the best case scenario, because now they know what they signed. There's support there. If there's an invoice they need to review, they can go ahead and sign them and mail them out, or go someone independent. What we don't want to happen is those checks then to go back to that same person that prepared them and they mail them out, because you can, you know, do check washing and change the name of the payee or something like that. So scanning them before it's mailed out, it helps. I still like to do it afterwards and follow the money, see what actually was done. So hopefully that answers that question for that one. The fraud hotline, I will get back to that on kind of some information. And this is out there probably on our website. If not, you can reach out. I'm going to put my email up so I can respond back to people as well. So yeah, so there's Kyle and my email. If it's cyber or accounting, I'll get those information on that one.